Welcome back. You're listening to Randy Barkley and Jeremiah Lee. We are with Tricord Advisors. Tricord is a registered investment advisory firm. I'm a certified financial planner, and Jeremiah is also a certified financial planner. He has the additional distinction of being an attorney, and he helps our clients with estate planning and other legal issues that help them make smart decisions with their money. We're going to continue the conversation about income, and we're going to delve into an area that it's become very complex.
Yep.
And that's inherited IRAs.
Yep. So for most people, the idea is if your parents had an IRA, they were using it during their lifetime, but they didn't use it up. There are some leftovers. Well, the rules, they've shifted of what happens to that account. It used to be that you would inherit it, and then you would basically stretch it over your lifetime. And all of a sudden, those required amounts have to come out, those required minimum distributions each year, they applied to your life. Well, that all got changed. That all got wiped away.
Now, this is 2019, so it's just a few years ago, but it did change all of the planning that people had done prior to that. It changed the layout of the stuff.
Yeah. So we'll start, I guess, with the general, that if you're a spouse, if your spouse passes away, you can still take their inherited IRA that you received from them, roll it into yours, take it over, and stretch that over your lifetime.
Right.
That hasn't had a big shift. But nearly everything else does. There's also a few other exemptions for someone who's a disabled child. There's a few others in there, but they're pretty narrow. The vast majority of people who are kids inheriting from their parents, they now have this 10-year rule. And the 10-year rule says that whatever account balance was left over that you inherit.
Basically any non-spouse beneficiary, just to kind of be clarifying on that, but go ahead.
Yeah. You're going to have to take out all of that money within 10 years. So when the first rule came out, the way it was written, it said just that. You have to take it out within a 10-year period.
Right.
Whether you chose to take a little bit each year and spread it out, or took nothing for 9 years, and in the 10th year you took one large distribution. Those were kind of your options. Well, the IRS has since issued some tentative guidance of what the rules are.
This is what's really frustrating, because they haven't really given us a permanent decision based upon what these distribution rules are going to be. Right.
There's no final one. A lot of people know the law comes out and says something broad, and then the IRS or any other administrative agency will make very specific rules and requirements, and they send them out as a draft, and people comment on them and say, no, we hate that, or oh, that's great. And then at some point, the IRS or whoever the administrative agency they'll absorb those comments, and then they'll issue final rules. We're still in that process. So we have not yet received final rules. But what the guidance that the IRS sent out that's different than what a lot of people expected is they said if the person who passed away was younger than 70 or 72, they were not yet taking required minimum distributions, then the person inheriting that account, who is a non-spouse beneficiary, they could do just what we said, take it anytime they want between 0 and 10 years, spread it out, take it all at once, whatever they'd like. However, this is where it gets a little sticky. It's saying if the person who passed away was already taking required minimum distributions, or they were of an age they were supposed to, well, then now the person who's inheriting that account, they have to continue taking required minimum distributions throughout that 10-year period. And then at the end of the 10 years, they have to drain the account.
Right.
And it's not laughable. It's the IRS is making rules and choices what they feel this says. But the complexity of this, applying it to a real person's situation, becomes very difficult.
And then if you have a beneficiary that's a minor, that adds a whole nother layer of complexity, because custodians don't want to give money to somebody who's below age 18. And then you look at you're planning for when your income is. So if the recipient is somebody who's still working, they'd like to delay their money until maybe they've retired, so that the income tax ramification is not as significant. Yeah. And then you put on top of that Roths. So if you have a Roth IRA, you can't leave. Eventually, I mean, one of the disadvantages of a Roth, I mean, right now, is that they require you to take it out.
Yeah. So that's odd. So a Roth IRA, Randy, if you had one yourself, you don't have to take the money out. It's already been taxed. It's growing tax-free, and you can do whatever you want with it. However, if I were to inherit a Roth IRA from somebody, I'm still subject to this 10-year distribution rule. And it's a whole nother layer, right, of just complexity. And these aren't, we're not here to talk about the good or the bad of these rules. We just can see that they're confusing, and they're not yet final. So someone this year who inherited an IRA, you had a family member passed away, should you take an RMD? It's a question mark. Right. Some accountants are saying, yes, just be on the safe side, take your RMD just in case. Others are saying there's no final rules. We don't know that that's what's going to happen. It puts people in a hard spot. And There's some ways, and everyone can talk with their CPAs or accountants. There's ways to say you're sorry, to say, oh, I didn't take it last year. I didn't realize I was supposed to. And I think we're going to find a lot of people in that space to say, I did this wrong once the final rules come out.
Yeah, and I think unfortunately a lot of people are going to take out RMDs thinking that's the best thing for them to do because they're trying to follow the guidelines, and they're going to end up driving up their taxable income. Because remember, when you receive an inherited IRA, there's no step up in basis. This is all taxable. It's 100% taxable income that comes out to you. So if you push it out too soon, it could throw you into a higher tax bracket.
And the most common is that people inherit these when their parents pass away.
Right.
That's not the only way, but it's most common. So they're probably in their 50s and 60s, still working, still earning a good income, and they got to add this income on top of it. And that's where I think people feel the pinch of this.
So let's kind of cross over into dividends, because that's another source of income for most of our clients. It's in their investment accounts. I'm not going to get into real estate and the rental income off of real estate and such as that. There's a whole nother dynamic, different aspects that deal with that. But just dividends off of qualified dividends are treated like long-term capital gains, right? So they have a preferential tax treatment.
Yep. And so when someone has a taxable investment account, just good old-fashioned savings, they've saved up an amount of money, maybe they sold a house, maybe they sold some of their assets, and they have an account that is larger, and they get that invested. Well, there's a few ways to do it. One way is for capital appreciation. So saying, I want to buy Apple, I want to buy Facebook, I want to buy something that's going to grow over years. I don't really care what it does now. I just want it to grow. And eventually I'll sell it and I'll take the income. That's what a lot of people think about when they say investing. And that's what a lot of people do when they're younger. But what we're talking about is someone who has a similar pool of money, but they invest it into stocks that pay dividends. Microsoft is a great one. There's some others out there that they pay these strong dividends every year, which means that they push out some extra money to their shareholders. And for some of our clients, it creates a pension type income. Say the money's invested, they're not selling anything. They're not really trading the markets. It's rather every quarter they're receiving these distributions, these dividends from the accounts they hold. And if the accounts, if the size and the dividend payouts are enough, it funds their life. And so they're in a position to say, I don't have to sell any of this stuff. And if the market goes up or down, I don't mind this year because it doesn't actually impact me. Eventually I may sell this, or I eventually may give it to my kids, but I'm just living off of the dividends that are coming out. And it's a great structure for a lot of retirement portfolios. Yeah,
and I think this is the knock against annuities, because annuities are designed to have consistent rate of return and have tax deferral. You don't have to worry about taking out the income because you don't have to pay taxes until later on. But at the time of death, annuities all come out as all that untaxed gain comes out as ordinary income. And folks, there's a big difference between ordinary income and qualified income. And you have to pay, again, under these rules, if it's, again, that's why we're opposed primarily to putting annuities in place as an income vehicle, because the tax ramifications on annuities is different than it is on normal stocks or mutual funds.
Yeah, and a lot of people, the capital gains and the personal income tax rates change dramatically depending on where you're at. But it's not uncommon to have someone who pays 15% capital gains and they pay 28% earned income or ordinary income. And so with that, they're looking at it over a 10% swing of how this stuff is taxed. And I don't know anyone that signs up for 10% more taxes.
Well, yeah, and I think the thing that's happening is the laws are changing, and so whatever you set in place 10 years ago, I think people are now all of a sudden surprised, and particularly the heirs, because if the person who set up their planning, so to speak, 10 years ago, and the laws have changed. I mean, going back to inherited IRAs, but also IRAs. So, and then dividends. The one thing they've left in place, though, is the capital gain rules. So if you hold an investment for a year and a day, you're under long-term capital gains. You're not under short-term capital gains, and that's a big planning issue too.
Big deal. Yep. And it ties people, for good or for bad, into some portfolios. If you've picked up a portfolio of assets, you want to try and hold it for a year, if possible, to get that better treatment. And so it's a little more of, not just, I heard on the news this stock was good, buy, or oh no, what's happening, sell, but to say, I want to have a long-term plan, a long-term strategy where you build a portfolio that makes sense for you, not just today or tomorrow, but into the future. And not entirely to say regardless of what the market does, but generally that's the idea. You want something well diversified that you don't have to lose sleep at night. You don't have to have your finger on the buy or sell button with this great concern. You want something that is going to be useful for you, throughout the decades even.
For sure.
And that's part of building a portfolio that makes sense for each person. So
Yeah,
we're talking about the kind of the fullness of the
Right.
picture, and everyone's different. I mean, we not touched on pensions. We have a number of clients who have a pension, and when someone has a good pension, it kind of takes the rules of thumb about how much you need in retirement, like how much you need in a 401k. It throws it out the window. And the other aspect is in what you're going to inherit from people. We've had a number of clients who a big portion of their accounts are inherited from their parents. And it's just very unique of what your income looks like in retirement.
And I think that really comes to emphasis of what we do as a firm. We're not just doing investment work, but we do what we call wealth management. And it's creating that legacy for our clients going forward. And oftentimes, again, I've been in business now for nearly 40 years, and I'm now dealing with, in some cases, that third generation.
Yeah.
And it's that money. I had a client recently who passed away. She was a client of mine for 37 years. And I'm dealing, unfortunately, her daughter passed away before she did, but I'm dealing with the grandchildren.
Yeah.
And how do we distribute and how do we manage that money going forward for them? And the legacy planning is a big part of that income production. In other words, how do we keep that income and how do we avoid taxes? How do we deal with the step up on basis? All these factors kind of come together on what I call wealth management.
Yeah. And some people see this moment when you inherit something or have these assets as this, I have to pay taxes, this negative. I see it as an opportunity.
Right.
There's some opportunity to make some really good choices that set you and your family up for success.
For sure.
And making sure that people make those choices, that they know what they're doing and they lean into that.